A strange thing happens every time the stock market goes up. You'll hear headlines like, "The Dow Jones hits another record high." And yet, most people watching those headlines don't feel richer at all. In fact, many feel the opposite. More pressure, more expenses, less financial breathing room. So the question becomes uncomfortable but important. If the Dow Jones Industrial Average keeps rising, why do so many middle-class households feel stuck? Imagine a fairly normal situation in the United States or Western Europe. A 28-year-old professional, maybe working in marketing, tech support, engineering, finance, or healthcare. Something stable. Salary, $70,000 a year. After taxes, health insurance and deductions, that becomes roughly $4,200 a month in take, home pay. Now the monthly reality begins. Rent for a small apartment, $1,700 and car payment, $420 insurance and gas, $220 student loan payment, $300 groceries and basic living costs, $450. Phone, subscriptions, utilities, $250 credit card payments, $250. At this point, the math is quiet but very real. Out of 4, 200, about 3, 590 is already gone. That leaves around 610 for saving, investing, travel, emergencies, and everything else life throws at you. Now imagine the news appears on your phone. The Dow Jones Industrial Average reaches another high today. The market is rising, companies are growing, wealth is being created. But the average person watching the headline is left wondering, where exactly is that wealth going? The misunderstanding usually begins with how people mentally categorize the stock market. Many assume the market is something for later, something you start thinking about once income is higher, once student loans are gone, once life feels more stable. But there's a quiet mathematical consequence to this thinking. Let's keep the example simple. If someone invests $400 a month into a broad market index connected to companies similar to those inside the Dow Jones Industrial Average and earns an average market return of 7% per year, the numbers over time become interesting. After 10 years, that investment becomes roughly 69,000. After 20 years, about 208,000. After 30 years, close to 487,000. Nothing extreme happened here. No trading, no risky bets, just slow participation in the same market people read about every morning. Now compare that to a common alternative. The same 400 quietly absorbed into lifestyle upgrades, a slightly nicer apartment, a newer car lease, more frequent online purchases, weekend spending that feels harmless in isolation. Over 30 years, the opportunity cost of that decision is not 400. It's closer to $500,000 of future financial stability. So why do intelligent, hard-working people fall into this pattern? It usually isn't ignorance, it's psychology. Humans are wired to prioritize immediate comfort over distant security. A comfortable apartment improves life today. A newer car feels like visible progress. Investing, on the other hand, feels abstract. You send money into a brokerage account, and nothing visible changes. Your life today looks exactly the same, which is why many people postpone it, not intentionally, but gradually, year after year. Meanwhile, the companies inside the Dow Jones Industrial Average continue doing what they've always done. Selling products, expanding globally, raising prices with inflation, paying dividends to shareholders. And shareholders are simply the people who chose to participate earlier. Over time, the difference becomes less about income and more about financial positioning. Two people may earn the same salary for decades, but one slowly owns productive assets, while the other only consumes them. By their early 50s, the gap feels mysterious. One household has investment income quietly covering part of their living costs. The other still depends entirely on their paycheck. Both worked hard. Both paid taxes. Both followed the same economic system. But one made a small decision repeatedly that the other postponed. Financially aware people tend to look at the market differently. They don't see headlines like Dow Jones up today as exciting news. They see it more like a background economic signal. Large companies are still functioning. The global economy is still moving. Ownership of productive businesses still compounds over time. And participation matters more than timing. The point here isn't that everyone should obsess over the stock market or track the Dow Jones Industrial Average every day. Most financially stable investors rarely do. What they understand instead is something simpler. The market doesn't reward urgency. It rewards time inside the system, and that time advantage quietly compounds while most people are focused somewhere else. If this kind of calm, realistic breakdown of money and markets is helpful, consider subscribing to the channel. It simply helps more people see how the financial system actually works.